or cellular. Ever wonder why Big Wireless wants you on an unlimited plan? They probably want you to cover the cost of those 20-somethings using all that data every month. But most people 50 and up like me only use 12 gigs or less. Don't get bamboozled by Big Wireless. Switch to Consumer Cellular. Our plans start at just $20, and we use the same towers as the big guys. Join the millions who choose something better, because if you're not using all that data, you're probably getting used.
Call 1-888-FREEDOM, visit consumercellular.com/fax or a store near you. Plans include $5 credit for auto pay and e-billing. See site for additional facts.
My name is Dale Pazinski. I volunteer with United Way to help the homeless in my community learn computer skills and build a basic resume. I don't just wear the shirt, I live it.
Give, advocate, volunteer, Live United. Go to liveunited.org. Brought to you by United Way and the Ad Council.
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month titled Understanding Required Minimum Distributions. Mike, a lot of changes in the RMD landscape. When do people have to take RMDs from either IRAs or Roths?
How old are you?
Me personally?
So this does start changing now. It is currently 73 for a lot of folks. For some younger folks, it's actually now going to be 75 years old for your traditional IRAs and 401ks. And so that started at 70 and a half just a few years ago. And so this is a new set of rules for a lot of people.
When you look at how the penalty situation has evolved, this is one area that's actually gotten a little bit more lenient in recent years. And so that's something where if you are new to RMDs, there are some incentives if you've missed one to get that squared away as soon as possible.
There are, but, key takeaway. Understand these rules and don't miss your required minimum distribution, because there are still penalties for something that, again, is completely avoidable. Yes, the penalties used to be bigger. They are less less stringent now and a bit smaller, but it is still unnecessary extra taxes and fees that you will end up paying if you do miss your required minimum distribution. So get our guide and learn a little bit more about how all of this works.
Folks, the guide is titled Understanding Required Minimum Distributions, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by visiting ArmstrongAdvisory.com. Again, that number is 800-393-4001, or you can request it online at ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We pride ourselves on being able to support veterans in their time of greatest need, ensuring they receive the protections they deserve. For over 100 years, the DAV of Massachusetts has helped thousands of veterans with housing, transportation, and medical assistance, and you can help too. Please visit dav5k.boston and make a donation today. That's dav5k.boston.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Well, on Friday, markets took it on the chin over China tariff announcements. Over the weekend, President Trump alleviated some of those concerns, ensuring everybody that we would come to a deal. Markets floated back upwards, erasing about half of their losses. And then this morning, we have new escalations on the U.S.-China trade front, and we have markets sinking once again. It's been an interesting 3 days after a historic bout of low volatility and just markets moving their way upwards for the last several months. It's Mike, Paul, and Tucker with you on a Bank Earnings Tuesday. We did hear from JPMorgan Chase, Goldman Sachs, Citigroup. Who else was in there, Paul? We had
BlackRock, Wells Fargo.
Yeah. So a whole slew of bank earnings to get through and some interesting commentary from some of the CEOs. Yesterday, we posed the question, what sort of exposure might some of them have to the recent auto bankruptcies and the seemingly fraud in some of those instances. So we'll be covering that. But markets are being driven today, at least, by the China news, and so we need to start right there. So overnight, China escalated the U.S. trade fight with some curbs on shipping. What did they announce, Paul? We can get to the market reaction here, but what are we seeing on the U.S. and China trade tensions front?
China sanctioned the U.S. units of a South Korean shipping giant and then threatened to have further retaliatory measures on the industry. In particular, they sanctioned 5 U.S. units of Hanwha Ocean Company, and that's sort of the latest back and forth that we've seen between the two countries. Obviously, prior to this, as you likely covered on Friday's program, all the actions that have been in place with the rare earth materials. But now what we're dealing with this morning is specifically targeting on the shipping front what you've had over the course of the last couple of years or so. But this issue goes back a decade, is where China really dominates in terms of shipbuilding. They've sort of overtaken the lead from South Korea and Japan. South Korea had committed $150 billion in expertise and investments to try and stimulate U.S. ambitions in the sector, because to be clear, we don't really produce chips at all anymore. And as a result of that, the theory behind some of these moves is that China is really trying to stick it to South Korea to make them decide, are you with us? Are you with them? In that case, that would be them being the United States.
Yeah, so another shot across the bow here. Frankly, if you end up in a place where China doesn't sell any rare earths to the United States and the U.S. slaps 100% tariffs on all Chinese-made goods, then sanctions on U.S. shipping investments are irrelevant.
Sure.
And so I look at this story as not so much the relevance as, oh, look what they did now. We've escalated to the point of targeting shipping giants. I think that's far less important than rare earth materials and tariffs on all Chinese-made goods. What it does indicate is that the words that we have heard over the last several days of reconciliation or attempting to de-escalate by Scott Bessent or President Trump himself are put into a new light here. They're cast into a new light when you have an announcement like this, because this is the exact opposite direction. And it is once again, I think, Chinese leadership kind of looking for an attempt to embarrass the United States here on these negotiations. So again, to be clear, on Wednesday, I believe it was Wednesday night, you first had the announcement from China that they were imposing new export restrictions on rare earths. And that started with, I know we've covered this a few times, but it's important to repeat, basically requiring licenses for any company who sells a product where more than 0.1% of the finished value of that product is derived from the rare earths that China sells them. That's like everything. Certainly cars, semiconductors. I don't think it would include like my kids' Labubu dolls that everyone's obsessed with, but just about everything else is going to be captured by this requirement. And so, again, it doesn't necessarily restrict the sale, but it does say if you want these things, you have to apply for a license through the Chinese government before we will sell you the stuff. Okay. Friday rolls around, and just before 11 a.m., President Trump announces on Truth Social that this is a big escalation, that he sees no need to meet with President Xi based on this at their upcoming scheduled meeting somewhere in the Pacific region. I don't remember where that's scheduled.
I believe it's in South Korea.
In South Korea, okay. And threatens 100% tariffs on all Chinese-made products. Markets sank nearly 3% on that news through the rest of the day. Just a steady sell-off through the rest of the day. Friday, over the weekend, the president, alludes to the fact that, I don't think he even said he hopes, but there's a possibility that these tariffs never go into place if we can reach some sort of deal. Scott Bessent says the similar thing. Markets move up yesterday, and then today we get this, and markets are selling off. So it's been, a interesting 3 days, and honestly, this is the most markets have paid attention to anything tariff-related since April.
Definitely.
And I consider that to be significant. I do think that that's important for us to acknowledge that markets are paying closer attention to this at any more attention to this than at any time since April of this year. I got to be honest, though, since the beginning of this, when this was first, we had the opportunity to cover it on Thursday, my attitude towards it has been, this seems like posturing ahead of a negotiated summit. Mm-hmm. You now have a bunch of things the Chinese do that they are putting on the table that they can walk back from the table. The direction of negotiations over the last several months since April has been a positive one. You've made a deal on TikTok, which I don't, again, not the biggest deal for anybody, and it's not a huge move the needle item for national security in my view. But again, taken with everything else, was a step in the right direction. And this is seemingly a step back. I'm encouraged, and I think investors were encouraged by the fact that the president himself has come out and said words of de-escalation and don't worry about this. And to me, that's the exact same wording he was using back on April 8th or April 9th.
Right.
He was coming out there and saying, this is not something to worry about. The markets are overdoing it. Don't get concerned about it. And based on his actions, he was right.
Sure.
Like he readjusted everything, took a big hard look at all the tariffs that they had announced, waived a bunch of them, delayed a bunch of them, and based on those actions, markets were, as we look at it now, pretty oversold and have appreciated dramatically based on all of that. The question, of course, is is right now another instance of that same effect, where this is all posturing and it's about to go away? Or is it a new escalatory environment? And frankly, this is the difficult part of investing in a game of chicken. My guess would be that we get a similar result to what we got back in April, because that was the most recent result, and that's what we have the most evidence to point to. But when you have a game of chicken between two world superpowers that are, staring down economic gridlock and dealing with, parties in their own country that are pushing for certain outcomes, you don't know which direction it's going to go. And so for that reason, I think markets are taking some appreciation here, or depreciation, but appreciating the gravity of the issue of the moment, even if it seems pretty unlikely to escalate in my mind.
I think if you step back and ultimately think about what each party on the negotiating table stands to lose if this is to get worse and to get exacerbated, it really doesn't help anybody if this is to continue, or they're forced, these respective countries, both China and the U.S., to go to these levels that are mentioned here.
Sure, it devastates the Chinese economy.
Yep.
It devastates the U.S. economy.
Right.
Right? Like, it's no... We can talk about which one is worse off in these scenarios. I honestly am not sure. I think our economy probably fares a little bit better, whereas China's defense network probably fares a little bit better in all of it. But in either case, it's devastating to both economies, right, and really, really problematic. And so to your point, I can't imagine we get to a point where China just says, nope, no rare earth materials for any U.S. end-made product, and the United States says 100% tariffs on any product moving from China, which, by the way, just means no product moving from China to the United States.
Yeah, it just, the image in my head is just two cars, like you said, a game of chicken, driving directly at each other head on. What benefit is there to either one to crash into one another?
So again, taking recent history.
Nice. There we go.
Wow, Tucker's just
He's
Johnny on the spot with the sound effects today. Taking recent history into account, you would bet that this stuff de-escalates, but you'd never do know until that comes. And do you know the date of the scheduled meeting in South Korea?
Was it the 29th? It's towards the end of the month.
So towards the end of the month, this is scheduled to happen. Whether or not it happens will be a pretty big tell in terms of where this goes from here. Let's take a quick break. When we come back, a bunch of bank earnings to digest, and all taken in the context of two big bankruptcies in the auto space. What do the banks have to say about that and their general earnings? That's next on the Financial Exchange.
The Financial Exchange streams live on YouTube. Subscribe to our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73, or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Services. Cushing & Dolan want to help you make the most of your estate plan, starting with how you gift your assets. Their brand new guide, Making the Most of Gifting Assets, breaks down the pros and cons so you can avoid costly mistakes. Gifting may sound simple, but it can create complications you may not see coming. For example, if you gift your primary home to your kids and they sell it, they could face huge capital gains taxes, and that surprise bill could derail your plan. It's the kind of insight that can help you protect what you've built and keep your family's future on track. Whether you're just getting started or you're deep into your estate plan, this guide from Cushing & Dolan is a must-have to make smart, informed decisions. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts, and this year's DAV 5K is Saturday, November 8th at Castle Island. The race is now sold out, but you can still take part by making a donation to support our great American heroes. Please visit dav5k.boston to make your gift today. Your participation helps provide vital services like free transportation to medical appointments and safe housing for single veterans and their families. Donate today at dav5k.boston. That's dav5k.boston.
So we had four major banks reporting earnings this morning before the bell: Goldman Sachs, Wells Fargo, JPMorgan, and Citigroup. Just covering the market reaction to these four companies. Goldman Sachs currently down 3.6% in early trading. Wells Fargo up 4.2%. JPMorgan Chase down nearly 2.9%. And Citigroup up about 0.9%. Again, taken in the context that today markets are selling off a fair bit on the S&P 500, about 0.2%. But let's start right off with the biggest of them, JPMorgan, who beat on profit and revenue. Profit did jump. What do you suppose might be moving the stock down today as we've got, again, a slight sell-off? My take was that it's kind of the Jamie Dimon's commentary and loan loss provisions that are out there. But, we do have the stock moving down a fair bit on a beat on profits.
Yeah, I was trying to reconcile that this morning, looking at the pre-market and now the activity that we've seen the first hour of the show, because all these numbers are relatively solid. The one potential concern that you can mention is they did set aside a little bit more than was anticipated for credit losses, where initially there was an estimate that the reserves that they would set aside was about $3.08 billion for losses from some of the loans that they had made. That number came in at $3.4 million, so a little bit higher, $3.4 billion, a little higher than anticipated there. But ultimately, you're talking about a company that does $46 billion of revenue a quarter and just reported $14 billion of net income for the quarter. So I don't want to make it seem as if this differential on credit losses is so significant that it should be sending the stock down as much as it is.
Right.
So other than that, it can only be commentary from Diamond, but the market should be used to his pessimistic measured commentary for the last decade. So I'm a little bit scratching my head as to why that would be the case, because otherwise these numbers are pretty strong.
They are. Continuing on to the other three, so Goldman Sachs beat on both profit and revenue. Where they specifically saw a lot of help was investment banking revenue. We're seeing more deal making. That is boosting this company's stock. They had some weakness in other areas, but the deal making was enough to see a fairly solid quarter there. And nonetheless, that equity trading concerns moving the stock down 3.6%. So again, beat on expectations, but with a bank like Goldman Sachs, they wanted to see a little bit more, it seems. Wells Fargo, on the other hand, beat on both earnings and sales. They also raised their targets. So that would be one piece that I think you can point to. They saw strong net investment income, revenue growth, as the commercial and consumer businesses did fairly well. Finally, Citigroup beat on revenue but missed on earnings per share. So a bit of a mixed report from Citigroup, but expectations weren't all that high. If I looked through these different earnings and I caught clips of each of the CEOs speaking, didn't listen to the entire press conferences, but there are a few things that I kind of saw there that looked like common themes. One, both Solomon, CEO of Goldman Sachs, as well as Jamie Dimon, pointed out some of their concerns. Jamie Dimon's were far larger than David Solomon's. Basically, David's only quote was, conditions can change quickly in spite of where they're seeing things right now, whereas Jamie Dimon was just talking about a heightened degree of uncertainty stemming from geopolitical, tariffs, trade uncertainty, asset prices, sticky inflation. He cited a number of different things, which also makes me think that there is no real direction there, because he's just saying every possible thing that could be a concern is a concern for him. The consumer health piece continues to be an item that investors or CEOs are bringing up. Again, these banks tend to make their money off of the very high net worth consumer, and so I don't think they're seeing it show up in their financials, but many of them have talked about stress for lower income consumers, and analysts especially have been pointing that out. But I think for these four banks, it's not really a concern. There are other financial institutions where it could be. The area that's been of interest to us over the course of the last few weeks has been the auto sector. Mm-hmm. And so I've been kind of on heightened alert trying to find out which banks might have any exposure to this. Jamie Dimon, JPMorgan, was really the only one of these four that cited it. And his point was this: drop in the bucket for us. Definitely. Specifically, his bank had exposure to Tricolor. So this was the subprime auto lender. And he specifically pointed out that this is something that we normally wouldn't even talk about, but it has been getting a lot of attention, and so he spoke about it specifically. They had charge-offs of about $170 million in the quarter, which, again, irrelevant to Jamie Dimon and JP Morgan, but he did cite it as, not our finest moment was his word. And I bring that up because I'm interested in the Tricolor piece and who has exposure to it, but it is the second time we've talked about JP Morgan in the context of not their finest moment. The first one was the fraudster who had been faking a business. Frank accounts. Was it Frank was the business?
Oh, jeez.
I think that was the name of the company that she sold to JP Morgan for, basically a bunch of fraudulent customers. And so they have some exposure there. Fifth Third Bank has disclosed that they have quite a bit of disclosure, bigger deal for them than it is for JP Morgan. Barclays also seems to have some exposure to it. And then on the First Brand side, this was the auto parts supplier that is still working through their bankruptcy. You have big exposure from UBS, as well as Jefferies. And so we'll be diving into those more over the course of the next few weeks. But again, were these the only two issues? I don't think it would be a systemic problem. Our concern is where there's smoke, there's fire. It is the hypothetical here, and I don't know. I'm not convinced that in this case where there's smoke, there's fire, but when you have two companies attached to this space that have similar kinds of issues, right? I mean, they're both dealing with too much debt, a bunch of lenders that didn't really realize how much debt they had, and both marginally attached to the same industry. You start to wonder just where the other stuff starts popping up. And the good news is it's not popping up in any of our major banks. The bad news would be that means it's somewhere else.
Right.
Quick break. Wall Street Watch is coming up next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting ArmstrongAdvisory.com. That number again is 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan, with their master's in taxation. And today we're talking about the implications of gifting assets away. Todd, if you're trying to protect your assets from the cost of long-term care expenses, what are the risks in giving your assets to a child rather than transferring them to an irrevocable trust?
Yeah, it's a very big difference, right? These irrevocable trusts that we do for Medicaid purposes, first and foremost, are incomplete gifts. So you're not actually making a gift at all when you put it into these trusts. But if you give it to a child, now you've made a completed gift. So, for example, if I gave away my house, and people do it, right? You are giving away the built-in gain in that house. You now don't have any control over the house. You can't sell it and buy another one if you want to move. You need the kids' permission for all of that. Plus, if you never sell it and you die, you've trapped the built-in gain for the kids. When they go to sell it, they're going to have to pay capital gains tax. Whereas if you keep it, you can control it, get a step up in basis for the kids when they die, and still protect it from the nursing home through the trust. Either way, it's going to take 5 years. But gifting isn't always the answer.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy on their website, LegalExchangeShow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are giving back gains from yesterday's rally after further escalation of tensions between the U.S. and China after Beijing moved to effectively ban Chinese companies from doing business with U.S. subsidiaries of a South Korean shipbuilding giant. Outside of trade, Wall Street's also sifting through third quarter bank earnings posted earlier this morning. Right now, the Dow is down by 0.3% or 136 points lower. S&P 500 down nearly 0.6% or 38 points lower. NASDAQ down 1% or 227 points. Russell 2000 is down about 0.25%. 10-year Treasury yield is flat and currently at 4.042%. And crude oil down nearly 2% lower, trading at $58.37 a barrel. JPMorgan Chase beat third quarter earnings expectations, where its trading revenue hit a record of $9 billion. Shares are down by 2%. Goldman Sachs also exceeded estimates, posting better than expected investment banking activity and bond trading. Goldman stock is down by 3%. Wells Fargo beat third quarter expectations as well, where the bank raised its profitability target, sending that stock up by 4%. BlackRock and Citigroup also beat third quarter forecast. Those stocks are seeing modest gains. Outside of bank earnings, Johnson & Johnson beat third quarter estimates and raised its annual sales outlook. The healthcare giant also said it plans to split off its orthopedics unit within 2 years. J&J stock is down nearly 1%. Meanwhile, AMD shares up 2% after the chip maker struck a deal that will see its AI chips used in data centers run by Oracle. According to the Wall Street Journal, Ford is temporarily cutting production of at least 5 models following a devastating fire at a crucial aluminum supplier's plant. Ford stock is flat. And General Motors is cutting electric vehicle manufacturing capacity, citing reduced demand following the end of EV tax credits. The company will take a $1.6 billion hit. As a result, GM shares are edging higher. I'm Tucker Silva, and that is Wall Street Watch.
As we are now 6 months into the President Trump's newly announced tariffs, we're starting to see the map of international trade really change. One very obvious one that's not obvious to folks here in the Northeast would be agricultural trade. China is effectively importing very little agricultural goods from the United States. A lot of that shifting to South America instead, Brazil specifically. And so if you grow soybeans, for example, in the United States, you're having a pretty tough go of it. But even, less obvious things, right? Canada purchases of cars. They're mainly importing cars from Mexico now instead of the United States based on those tariff concerns. And so we're seeing a lot of this reshape. What we are seemingly not showing is big surges in U.S. inflation. Mm-hmm. And globally, too, by the way. Like, any of those big concerns about price increases across the board have not shown up dramatically yet. And it's not to say that they will never. We'll get another CPI report, I think by end of next week, if I'm not mistaken. Tucker, is that right? The BLS being called back. I think it's by end of next week we'll get that report, maybe this week.
CPI?
Yeah.
Yeah, next week, 24th.
Next week. Okay. So we'll be getting that report on where prices have gone, but I expect to see it fall somewhere in the 3% range. One other, just interesting piece on the whole tariff side of things. I've been following since she came on the show. Jenny Tang works for the Boston Federal Reserve. She has been doing surveys, or their office has been doing surveys on, just who will pay for tariffs and where are we seeing it. Because, like I said, I think by and large, you haven't seen a huge effect here in the United States from these tariffs. And I think a lot of large companies especially have been able to rejigger their supply chain or put pressure on suppliers to keep prices down, whereas those smaller businesses have not so much seen that effect. And Jenny notes that in her research that, when you talk to those small and medium-sized businesses where they employ fewer than 500 people, the expected pass-through rate on tariffs is pretty high. It's about 50% of businesses say they plan on passing through those tariff rates. That's actually lower than it was back in April when we had the real concerning stuff for small businesses, but it's fairly high. And so where I land is I'm really unsure as to whether or not we will get a lot of direct pass-through of tariffs and a true dramatic increase in prices in the short term from tariffs based on big businesses' ability to absorb some of that. But I do have some pretty big concerns for smaller companies that are exposed to tariffs.
Definitely, that's been my biggest concern this whole time, is that this could create a further divergence between kind of Wall Street, not Wall Street and Main Street, but big businesses versus the small to mid-sized businesses, because they already have a tremendous amount of scale and advantage. The Amazons, think of all those big retailers out there, and these tariff policies only really allows for them to utilize their scale and just their leverage to not benefit from it, but do a better job of siphoning off any type of impact versus your local mom and pop shop that don't have that same sort of flexibility.
Right. And to be clear, maybe that bigger problem then is for employment.
Mm-hmm.
Right? Because while small businesses might not represent a huge portion of your budget, they employ about half of Americans.
Right.
Right. So this data is a little bit old. It's from 2023. But businesses with fewer than 500 employees, according to the Office of Advocacy, businesses with fewer than 500 employees employed about 46% of the private sector workforce. They make up about 99.9% of all businesses in the U.S. That one makes sense. But, 46%. Now, not everyone is impacted by tariffs. Our business is not affected directly by tariffs in any meaningful way. But yeah, half of American workers work for those small companies, and a number of them are, and a number of them probably have no choice but to absorb it because, if you have $1 million in sales a year, you're not going to have a lot of ability to pressure that Chinese supplier to lower those prices.
Definitely not.
Paul, silver prices just hit their first record since 1980. Gold prices have been there for a little while now. What are we seeing in the other commodities?
It's just been a crazy year for metals in general. You've got gold up 56% year to date, and silver now is up 73%. It has hit that record that you alluded to, which is $50.13 per troy ounce. That was ahead of the 1980 record. And the reason I like to highlight it a bit is because that 1980 record came about from a scandal that was ultimately made into an Eddie Murphy movie called Trading Places, where the Hunt brothers, one in particular, put together a scandal, not a scheme rather, to put together 1/3 of all of the available silver in the world and caused a ton of market manipulation to drive that 1980 record price, which was at the beginning of the year in 1980, in January of 1980. As a result of that, the Commodity Exchange had to make a rule on March 27th of 1980 saying that you could only sell silver. And as a result of that, the price of silver went from $48.70 to $10.80 a share. And imagine having 1/3 of all the silver in the world, 100 million ounces is what they had procured, and they were leveraged to the gills. So there's 3 Hunt brothers. There was one who was involved, I believe Herbert was his name, $1 billion of losses, all sorts of different issues that came from this, but it was something that really caused the commodity industry to put a little bit more scrutiny on some of its practices on the market manipulation side of things.
Forced to move into the ketchup industry. Just devastating.
No relation there with the Hunts, but I don't think, at least, they're all over the place.
Could be. Who knows? I completely made that up right now.
They're in the NFL and they're elsewhere. But the reason why it's noteworthy today, besides going back to the 80s, 80s is that there's a lot more consumption on the silver front. You have AI, EVs, and just the energy transition in general that is requiring more silver. Solar panels in particular, higher need for silver. That has really driven up a lot of the demand. And there is some scarcity of supply, hopefully not from anything like what was going on in the 80s with the Hunt brothers, but it has been just a incredible year for metals. Silver, at least, it's the use case that is kind of driving some of this up, but gold also seeing tremendous demand as well.
It is pretty shocking, though, to think that it has taken 45 years
That's
to
the other
recapture a high, right?
Granted, that high was kind of falsely created.
And had you bought it years later, then you would have made a tremendous amount of money over the course of the last 40. But if you had invested $1 in in gold, in silver, and $1 in stocks over the course of the last 45 years, you'd have a pretty big difference between how much you'd accumulated by then. Let's take a quick break. When we come back, Ford cutting production on some of their vehicles. We'll talk about why next on the Financial Exchange.
The latest news on inflation, the Fed, the economy, and how the markets are reacting every morning right here on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
Well, we spoke about last week the fire at the aluminum supplier in Ohio?
Upstate New York.
Upstate New York, excuse me.
Close.
Yeah, you got they're right next to each other. I-90 cuts right through both of these places, guys.
Don't tell Todd Lutzke that.
In any case, the fire at the aluminum supplier knocking off production to Ford's, well, several of their most valuable and profitable vehicles. They're temporarily cutting production of at least 5 models, including popular SUVs, F-150s, because this one supplier accounts for pretty much all of the domestic supply of aluminum, and if you import it from elsewhere, you're talking about 50%
big
tariffs.
Yeah.
So, yeah, their cars are already expensive enough. They can't quite justify paying a giant tariff on a whole bunch of aluminum, which I'm sure they will eventually justify because you're not just going to stop making Explorers and F-150s for a prolonged period of time. But certainly doesn't help much for Ford, who, look, I mean, they are already struggling with all sorts of other supplies. They can't make these vehicles if China puts in their rare earth materials. You need a whole bunch of magnets to make any of these engines work and any of these other things to work. So they've already got some supply chain issues. This one is a fairly critical one that is slowing down production. But even if they do find a new supply of aluminum, there are some other threats to this business that are unique to Ford, and GM seems a little bit more prepared for. We have not seen a similar announcement from General Motors on this same issue when it comes to aluminum supplies.
It's surprising how well Ford stock has fared year to date with some of the headwinds that they're battling, whether it be on the tariff front, which they're anticipated of paying $2 billion in tariff costs this year, and just in general, their EV investments are, creating a lot of losses too. Obviously, their bread and butter of the F-150 is still incredibly profitable, and that's probably what has kind of kept them up or kept them hanging around year to date. But it's very clear by this shift that it's really all hands on deck on the production side to focus on the F-150s, and clearly with these other 5 models, which don't have the same popularity, they're just halting for the moment to get by with their crown jewel, you'd kind of think.
I'll tell you, the entire auto sector just seems like a mess to me.
Yeah.
Like, especially with these two companies, it's becoming increasingly evident that they don't really have the ability to sell their cars pretty much anywhere else in the world because China keeps putting them out of business. And so, is what we're facing, not that the American market is anything to poo-poo. We have a terrible car buying appetite and spend a ton of our money on these things. But these companies do not look all that attractive if they have to make everything in the United States and only can sell into the United States. And that's not directly where we're going because other countries have recognized the unfair trade practices of China and started to clamp down on them. But increasingly, every country is kind of coming to the same conclusion of, we need to protect our auto industry. And in that universe, it means, to me at least, very expensive and kind of boring cars.
For what was always a really hard business to be effective executors in, right? Because it's a low margin business in the first place and heavy in terms of capital expenditures. So it's not easy to do well.
Cushing & Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide is called Making the Most of Gifting Assets, and it shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure, or legal issues like a divorce. The guide also explains how a major gift like a home or a vacation property could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing & Dolan called Making the Most of Gifting Assets. Call 866-848-5699 right now to get your copy. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Tucker, we have a new U.S. record to announce. Would you mind queuing up the balloons and just party-related items? Because for the first time ever, new vehicle prices topped $50,000 on average in the United States. So the average new car, not the highest price that you can get, but the average new car sold in the United States topped $50,000 for the first time ever. I'm part of the problem. We bought a new car earlier this year, a new minivan, and that thing topped $50,000.
$200K?
In your defense, though,
a minivan.
In your defense, though, it is an essential vehicle with 3 kids. So I don't fault you for that one.
Yeah.
What else are you going to buy?
Could have bought a 10-year-old one, I guess. But nonetheless, we're sitting on a new, I think it came in at like $58,000, maybe $60,000 for a new minivan, which is insane to me, even saying it out loud, but anybody that's been shopping is aware of this stuff. $50,000 for the first time ever, and increasingly it's becoming evident that many, many Americans cannot afford that and aren't participating in it. Don't get me wrong, like they're buying used cars and doing other things, but the evidence is in the defaults on auto loans. I mean, the entire reason that Tricolor went bankrupt, I mean, the underlying fundamental reason might have been because of allegations of fraud and other concerns, but the mathematical reason they went under is because a bunch of their customers could not afford to pay the loans on their vehicles anymore, or just refused to pay because they were no longer in the country. It is another story of this kind of K-shaped economy, right, where you have the wealthy supporting, upper ends of this economy and really driving the markets forward, whereas that bottom quartile to half is very much struggling, and we're seeing it show up now, not only in some of the data, but in actual companies that support that lower end consumer.
Yeah, I mean, you also have higher borrowing rates too, where the average new auto loan is about 9%, according to the most recent data from Cox Automotive in August for a new auto loan.
It flips all the math that anyone in financial planning has been doing for the course of the last decade and a half when it comes to, hey, should I pay off my car loan? Should I pay off my mortgage? Where should I focus my next dollar of savings investing versus paying things off? It really restructures that entire equation when you're talking about 9% auto loans. And that's for new ones.
9 times.
Quick break. Markets still strongly in negative territory. We'll have a full recap and more next on the Financial Exchange.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams, your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine, no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense. Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all 3 and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Understanding Required Minimum Distributions. Mike, one area with some big changes the last couple of years has been RMDs as it relates to inherited IRAs. What is the lay of the land today?
Yeah, so critical things that you need to know is that for most inheritors that are not spouses, so that's your starting point. If you are not married to the person who passed away, you are most likely subject to a out in 10 rule. What has also changed is that you're required to satisfy two different rules for most folks. Again, you are required to empty that inherited IRA within a decade. You also have annual required minimum distributions based on life expectancy. So it is really complicated now for inheritors.
How does that potentially influence how a parent may leave assets to surviving children in terms of taking their incomes into account?
Yeah, well, I mean, look, it is going to concentrate this additional income in a decade time period after you're gone. And so it adds a little bit of complexity in terms of that estate planning, right? Maybe I've got two kids. One's a very high income earner. One is a little bit lower. Do I potentially reshape my beneficiaries so that they both receive the same amount, maybe after taxes? A lot of complex planning you can do there.
The guide this month is titled Understanding Required Minimum Distributions. The two ways that you can request it are by calling 800-393-4001 or by visiting armstrongadvisory.com. Again, that number is 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Good morning. Welcome back to the Financial Exchange. It's Mike, Paul, and Tucker with you on a Tuesday morning here where markets are trying to stage a comeback here. Again, we had markets off nearly S&P was off 2.7% on Friday, rallied yesterday. This morning on further escalation from China, we saw them selling off. We had the S&P 500 at one point, at least in pre-markets, was down by 1.25%. We're now only down about 1/3% on the S&P, flat on the Dow, still down 0.8% on the NASDAQ. So we'll keep you updated on where things are going, but someone out there buying stocks in spite of the concerns of China and U.S. trade escalation. Got a dump of Wall Street earnings this morning from the likes of Goldman Sachs, JPMorgan, Wells Fargo, and Citigroup, who, as they always do, reported beats pretty much across the board, but stocks are kind of all over the place in reaction to them, some reacting positively on beats on expectations, others clearly missing where some of the analysts wanted to see things. In terms of the rest of this week, we will have continued earnings reports coming out. Today after the bell, not much, but tomorrow we will hear from Bank of America, Morgan Stanley, Abbott Labs, Progressive, I'm interested in anyone in the insurance space right now, just based on yesterday's or the weekend warning from S&P Global to insurance companies specifically about their exposure to private credit. So I'll be interested to hear from any companies that participate in the insurance industry. Want to hear from them and their exposure to this private credit blip that we've been seeing. PNC is also reporting tomorrow before the bell. Thursday, I don't think we have a whole lot. Charles Schwab reporting before the bell Thursday. Bank of New York Mellon also. And then Friday, we do have American Express reporting. So we'll see if we get that confirmation that we've been hearing from other companies that really service a high net worth clientele like American Express does, which is high net worth folks keep on spending in spite of their lower income counterparts pulling back quite a bit. Anything else catching your eye this morning, Paul, in markets?
No, I think you hit on some of the main aspects there.
So we've had this piece published a couple times. Bloomberg speaking about the great debasement debate and the trade that's rippling across global markets. And to be clear here, what you're talking about is a rise in asset prices, especially compared to global currencies. We talked about silver in the first hour of the show. Anybody that's missed it has, it's tough to have missed where gold has gone over the course of the last several months. Cryptocurrencies, stock prices, and others are appreciating dramatically. And the question becomes, well, if you're seeing every hard asset price move up at the same time, or even assets that aren't traditionally deemed hard assets like cryptocurrencies moving up, what does that say about investors' confidence in holding their own currency or holding assets that are denominated in their own currencies? And this piece at least makes the case that, hey, investors are growing increasingly concerned about global borrowing and countries' abilities to pay back that future cost.
Yeah, basically what you have is the United States government with, I believe, some $36 trillion outstanding from a debt perspective.
Woo-hoo!
And for the longest time, this has not been an issue. Well, you might hear pundits talk about it and economists talk about it, but it hasn't really warranted any sort of economic issue.
No, if you have bet on the U.S. economy struggling because of how much debt we've taken on,
you would have just been absolutely
You've been
bludgeoned.
wrong for the last 50 years.
Exactly.
In spite of the legitimate concerns that I personally have, any of those concerns, if you put them into a trading thesis, you've been wrong.
Exactly. And so now you are facing a period of time where there's potential for upward pressure on interest rates. Certainly, we went through an interest rate cycle of a 15 to 20 year span of time where interest rates were incredibly low. Who's to say what the next 20 years look like? But if there is $36 trillion of debt outstanding and all of a sudden, from a United States standpoint, it's questioned as to the viability of the United States government paying back its debt, which has never really been an issue. And if you look at financial markets, the risk-free rate of return that's assessed in finance is based on a U.S. Treasury. It is the gold standard, pun intended with the gold chatter, of being able to pay back principal. But as a result of all these debt concerns, you do see that potentially some of the market movements this year would lead to the fact that people are concerned about that debt level, and maybe that is what's driving up these natural metals. I don't know if I'm willing to make that leap just yet based on one tremendous year, to be clear, of performance for silver and gold. But if you were looking for ways to try and de-emphasize the impact of the U.S. debt in your portfolio, maybe these would be the places that people would pivot.
To me, this is not just a U.S.-centric focus issue.
Sure.
Right? I mean, plenty is being written about, the dollar and Treasury losing its reserve currency status, or Treasuries losing their safe haven status. Many people are voicing that opinion, but I think at least part of what's driving all of this is the same decision being made by many other countries. Right? You have most of the European Union lifting any caps that they had on deficit spending in order to, boost defense spending. You have that occurring in Japan. You have that occurring elsewhere. And so what was it wasn't just a United States issue, but we were definitely the biggest issuer of this debt. And That has certainly not slowed down. In fact, it's accelerated over the course of the last 10 years when you look at deficit to GDP. Even this year with the tariff revenue coming in, it has grown even further. But when you have every country in the world doing it at the same time, if you're sitting in France trying to evaluate, hey, what's the future value of my own currency and the future value of a bond that I'm buying and what will I be paid back in? Will the euro still be worth what it is now? You might be making the same bet that some U.S. investors are. And so even if it doesn't result in complete debasement of the dollar or a new normal for what U.S. Treasuries actually mean in global markets, it can still lead to asset price inflation, and that can cause a number of its own problems.
Ultimately, I'm just not ready to make the full jump yet. I think in a period of time, this is a reasonable case to write out this article, but with just years of history and the size of the Treasury market, perhaps there is a setback, but there are resources in place to correct this issue. I'd rather they address it sooner rather than later, but I don't think it's necessarily a long-term trend just yet.
Let's take a quick break. When we come back, somebody made $160 million in crypto markets on Friday, and the timing of the trades were pretty interestingly placed. We're going to be covering that and allegations of insider trading in crypto markets next on the Financial Exchange.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Cushing & Dolan want to help you make the most of your estate plan, starting with how you gift your assets. Their brand new guide, Making the Most of Gifting Assets, breaks down the pros and cons so you can avoid costly mistakes. Gifting may sound simple, but it can create complications you may not see coming. For example, if you gift your primary home to your kids and they sell it, they could face huge capital gains taxes, and that surprise bill could derail your plan. It's the kind of insight that can help you protect what you've built and keep your family's future on track. Whether you're just getting started or you're deep into your estate plan, this guide from Cushing & Dolan is a must-have to make smart, informed decisions. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's the Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
All right, time for trivia here on the Financial Exchange. And today would have been Roger Moore's 98th birthday. Moore is most famous for his time as famed spy James Bond. Moore began his run as James Bond with 1973's Live and Let Die and concluded his time as Bond with 1985's A View to Kill. So our trivia question today: how many James Bond movies did Roger Moore make? Once again, how many James Bond movies did Roger Moore make? Be the fourth person today to text us at 617-362-1385 with the correct answer, and you win a Financial Exchange Show t-shirt. Once again, the fourth correct response to text us to the number 617-362-1385 will win that t-shirt. See complete contest rules at financialexchangeshow.com.
So we here on the Financial Exchange have been focused on equity markets and the reaction to the president's announcement on tariffs on China. What has also been making a very big splash that we focus a little bit less on typically is what's happened in crypto markets since then. And to be clear, the sell-off that occurred, total liquidations on crypto derivative exchanges, hit an all-time high, and frankly, it wasn't even close on Friday. It was the biggest liquidation event you've ever seen in crypto. Doesn't mean it was the biggest sell-off you've ever seen on a percentage basis, but it was a massive event. It raised over $19 billion in value from the cryptocurrency. We were sitting at around 9:30 a.m. crypto, Bitcoin especially, was sitting at $122,447 per coin. By what time is that? By around 5 p.m., you got to a low of 108,000, a massive sell-off. It recovered some of that. Today, you're sitting at about $111,000 per coin. But you had this massive sell-off occurring, seemingly sparked by the president's announcements on tariffs. And because of the way that crypto trades, we're able to tell something very specific, which is 2 accounts made $160 million in trades on this specific information, and many of them very suspiciously timed with the announcement from the president.
Yeah, $160 million of profit on these 2 particular trades. One was placed a minute before Trump's tariff announcements, sparking speculation, as you would imagine, that this was an insider trading move. The other was slightly earlier, but between these two, it was deposits of $80 million and $30 million were put into accounts that were betting on Bitcoin going down. And then, like you mentioned, within minutes after the announcement that Trump made against China for potentially 100% tariffs, you saw a 12% drop in Bitcoin, making these positions that they took, which were short positions, basically betting on Bitcoin going down, incredibly lucrative. So like has been an issue historically with the stock market, issues with insider trading,
but at least with the stock market, like when you have something like this happen, so, for folks that aren't familiar, let's say you buy shares in an individual company, and minutes later it moves up on an announcement by the company when it comes to, some material fact that they had to disclose. The SEC tracks all of those transactions to your brokerage account and goes and talks to those folks. There was actually a local police officer in Massachusetts who was charged with insider trading based on this exact series of facts. He got some insider information from someone, I think it was at a biotech company, if memory serves me, placed a bunch of trades. I think the guy went to prison. Mm-hmm. If you personally own crypto today, this should make you furious because this is profiting at your expense. Again, I find it hard to believe that the timing of these trades, right, a minute before the president's announcements on shorting a bunch of crypto, I find it really hard to believe that was not somebody that had some sort of inside information. I'm not making, allegations that it was a member of, anyone's family, but it could be a press reporter. It could be, somebody who knew this announcement was coming. It could be a social media manager. Who knows? But if you invest in crypto personally, this type of thing should make you absolutely furious because it is costing you money as somebody who, believes in this stuff. So this stuff should make, it's also where I lead to my belief that eventually this is going to piss off enough people that this stuff's going to be regulated just like stocks.
Right.
And frankly, stuff like that should be. Right? If it's proven that you're in fact trading on inside information, that's illegal and it should be, gone after. But because of the nature of the regulatory environment for crypto, it makes it much easier to do in this space, whereas you just cannot pull that sort of thing off in the stock market.
What's so funny is that it would move this much on a policy announcement on
That's
economic
completely
policy.
Unrelated to crypto.
Right. I mean, that was the whole focus behind crypto in the first place. It was something that was supposed to be not correlated to anything, economic or in the markets, and yet you have it moving significantly off of something that the stock markets would move equally quickly on.
It is very clear to me that at this stage, most of at least the major, and we didn't even, we were talking about Bitcoin here. We didn't even talk about some of the smaller coins that got completely wiped out on Friday. But at this stage, for most of its time, if you go and track this and chart it against like the NASDAQ, it's basically trading as a leveraged NASDAQ type of holding, right? It's just a very volatile read on what's going on in the stock market. There can be other outside things that move it in one direction or another, but that's what it's looked like. And so when you have a massive announcement that is going to move stocks, it's a very easy thing to trade on with far fewer ramifications than making the same bet on stocks. Because you can be sure if somebody had shorted a bunch of the S&P 500 right before this announcement, they'd be getting a call.
Oh, yeah, big time. Just to expand further on the leverage piece, what Mike's alluding to is this idea that, hey, if the NASDAQ were to go down 1-2%, that typically something crypto-related that has more enhanced volatility characteristics would go down 5-6%, multiple times what you'd see from the major indices out there. And that's the deal with investing in crypto. It's very volatile.
So according to a Bank of America survey, most investors say that AI stocks are in a bubble, which now makes me question my narrative about AI stocks being in a bubble.
Because the retail.
If that's the consensus,
then
we're probably wrong, is kind of where I land on all of this. So one, Bank of America performed a survey. About 54% of participants in the October poll indicated that tech stocks were looking too expensive, which was a pretty significant about turn from where they had been, just a few months, or just last month rather. And so you now have the sentiment clearly shifting more towards the idea that, what sort of concerns should we have here about the state of crypto markets. Sorry, not about the state of crypto markets. We're talking about that last. About the state of these AI bets that are being made and what it means for the overall industry. But again, I guess I go back to, if you have a majority of respondents saying this, it makes it tough for the real crisis to happen in that moment. If everybody's worried about it, then everybody's preparing for it, presumably.
Right.
Or maybe they're not. Maybe they're just saying they know it's a bubble and they're just going to ride that wave.
What it might do is enhance sensitivity around any news related to AI that is more pessimistic in nature. I don't know if you get that anytime soon, but perhaps it does just have investors a little bit more.
The biggest argument I get from folks that this isn't some sort of bubble is, one, it's a super innovative technology that's going to change the world, and I dismiss that one. But earnings are still growing on it. And my counterpoint is, so did they back during the tech bubble until they stopped growing. And that is the point where stocks started collapsing. So I don't like to use the evidence that, earnings are growing as evidence that this continued rally can continue. Of course it can. So long as that continued growth happens, then of course it can keep going. The question is, when does that growth on earnings start to slow down and pivot to shrinking earnings? Quick break. We're going to have a full market recap coming up next. Stocks trying to mount a bit of a comeback, at least earlier during the 11 o'clock hour. We'll cover that and more next.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting armstrongadvisory.com. That number again is 800-393-4001 or armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served nearly 20 years, and we are so proud to have him and his business as a key partner and a presenting sponsor of the DAV 5K Boston. The DAV Department of Massachusetts does incredible work, and it's one of the first organizations that Mark became familiar with after his military service ended back in 1984. As Mark built his company, he knew he'd be giving back to fellow veterans who needed jobs, support services, medical supplies, and so much more. Mark works with disabled veterans every day, and it's one of the key reasons why he's such a big supporter of Dan Stack, the DAV Department of Massachusetts, and the DAV 5K Boston. You can join Mark Vonner and his team and make a donation to the DAV Department of Massachusetts or become a sponsor of the DAV 5K Boston. Simply visit dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about the implications of gifting assets away. Todd, since the estate tax laws are projected to change on January 1st of 2026, significantly reducing the estate tax exemption, does it make sense to gift away assets right now?
You know, it's a big question mark. You have to think of a few things. One, look at the size of your estate. If the exemption falls to $7 million each and you're married, you can still die with $14 million of assets and not have an estate tax. So gifting might not be important from a federal gift tax situation. But the state exemption is only $2 million, so you can only shelter $4 million. So you might want to gift to reduce your state estate tax. However, there's basis to consider. If you give away low basis assets, you're trapping capital gain. And to do that, you might be paying more in capital gains taxes later when the kids sell the assets than you're saving in just Massachusetts estate tax. So you really got to think about whether it makes sense to gift or not. And if you're going to gift, you should probably set up a gifting trust. People might be gifting large assets away and not gift the assets directly to a child. Have them in a trust for the child's benefit and then protect those assets for them.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 848-5699, or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets currently in negative territory after tensions between the U.S. and China increased. Beijing moved to effectively ban Chinese companies from doing business with U.S. subsidiaries of a South Korea shipbuilding giant outside of trade. Wall Street's also sifting through third quarter bank earnings posted earlier this morning. Right now, the Dow is down modestly now, only down 8 points, trying to claw back its earlier losses. S&P 500 is down nearly 0.5% or 30 points. NASDAQ down over 0.9% or 209 points lower. Russell 2000 is now edging higher. 10-year Treasury yield is flat, currently at 4.046%, and crude oil down nearly 2% lower, trading at $58.34 a barrel. JPMorgan beat third quarter expectations where its trading revenue hit a record of $9 billion. JPMorgan shares are down by 2%. Goldman Sachs also exceeded estimates, posting better than expected investment banking activity and bond trading. Goldman stock is down by 3%. Wells Fargo beat third quarter expectations as well, where the bank raised its profitability target, sending that stock up now over 6% higher. BlackRock and Citigroup also beat third quarter forecast. Those stocks are seeing modest gains. Outside of bank earnings, Johnson & Johnson beat third quarter estimates and raised its annual sales outlook. The healthcare giant also said it plans to split off its orthopedics unit within 2 years. Johnson & Johnson shares are down almost 2%. Meanwhile, Boeing said it delivered 55 aircraft to customers last month, putting it on track for its best year since 2018. 40 of the deliveries were 737 MAXs. Boeing stock is edging higher. And Domino's Pizza said its third quarter U.S. same-store sales grew 5.2% from a year ago, beating analysts' expectations. The pizza chain said promotions and a new stuffed crust pizza were helping boost U.S. carryout and delivery sales. Domino's shares are up over 3%. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked you the trivia question. How many James Bond movies did Roger Moore make? That would be 7. 7 movies. Jack from Portland, Maine is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Jack. We play trivia every day here in the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Well, as every day goes on, we seemingly get a new announcement between OpenAI and some other company that's going to be responsible for providing them with semiconductors, mainframe computers, power generation to power all of this stuff. And the most recent has been Broadcom. And on the announcement, their stock soared nearly 10% on Monday after this deal was announced with OpenAI, the maker of ChatGPT. Together, the announced deals that have been put together so far with OpenAI, it includes NVIDIA, Advanced Micro Devices, and others. They would involve filling data centers with chips and computing infrastructure that would consume 26 gigawatts of electricity. If it doesn't mean anything to you, it doesn't mean anything to me either. To give you a sense, that is substantially more electricity than what New York City currently uses at peak demand during the summer. So
it's a lot.
It's a lot of electricity. It would seem to power all of the air conditioning in New York City. It seems like a lot of electricity, and a lot needs to go right for all of this to work. Wall Street Journal is writing today about how this is a special risk for Broadcom. I don't think they have much of a choice for their investors but to participate in this. But I guess what is the risk for these chip suppliers when making these deals with OpenAI? Because, obviously this is the company who is at the forefront of artificial intelligence development. Yes, they're burning through cash, but they seemingly have a bunch of investors who are willing to throw more and more cash at them. So what is the risk to a company like Broadcom that signs a deal, that inks a deal to do business with OpenAI?
You're basically putting the cart in front of the horse, where you're going to have to spend a significant amount of investment in CapEx to build out these custom chips, to assist with the build out of the computing that's required behind this for a company that, don't get me wrong, was one of the fastest apps or products out there to reach 100 million users ever. I mean, their scaling of the use of OpenAI's ChatGPT has amazed many out there, and now they're standing at about 700 million weekly users. So there certainly is a lot of justified enthusiasm behind what they're doing, but it's a company also that is projected to do about $13 billion of revenue. I've heard maybe, it's a private company, so we don't know if that number is exact, but I've heard maybe closer run rate of $20 billion. But regardless, you're talking about hundreds of billions of dollars of commitment for build out on infrastructure that, Mike, the risk is OpenAI good to pay back all of this debt and investment that they're asking for many technology peers to take on as part of this initiative? You're really banking on exponential revenue growth for OpenAI once they get everything up and running.
Yeah, because to be clear, the deal that OpenAI is striking with Broadcom is not saying, hey, here's $100 million, go build this stuff out. It's, if you build the chips based on our custom designs that we need, then we will pay you for them.
Right.
That's years of build out that Broadcom needs to design and go forward with in order to actually someday sell these things. And if they happen to be, and it happens to be the biggest growth industry that we've seen since the internet, then it could be huge business for them. But if any number of things happens, Broadcom doesn't execute on the design of the chips properly, if OpenAI turns out to not have the revenue to pay them, there's any number of things that could go wrong for these companies, and Broadcom is in a position of, hey, we have to spend this money in order to get to the point where we could sell.
And now, with all the deals they've made, Mike, you've got the whole a lot of the technology sector is intertwined with this. Oracle had tremendous growth in its stock from announcing the 5-year, $300 billion deal that it struck with OpenAI. So all of this investment is on the optimism that they will turn out to be richly profitable and incredibly successful. And I think for all of us as investors, you want that ultimately, but there's a lot of risks that are in line there. It costs $50 billion to build out a gigawatt capacity of power. You were just talking about, 26 gigawatts that will need to be used. They're going to invest over the course of the next 5 years $1 trillion to build out the power capacity that they're looking for. And ultimately, you got to have the revenue to back this up. And what's probably not talked about a lot is that's just the installation of these data centers. It's not the ongoing maintenance and replacement of the chips within them too that will come from this. So it's fascinating. It's the biggest story right now in the market. It is truly a huge bet that a lot of these companies are making on this technology.
Paul, not only is it a huge bet for the markets at this moment, it's a huge bet for the overall economy. Our economy would not be growing in the way it is today without the actual spend that's occurring on artificial intelligence build-out. If this topic fascinates you, if you're interested in the direction this is going, we do have a few spots left for our event on Thursday of this week at the Showcase Superlux in Chestnut Hill. We're doing a live broadcast of the Financial Exchange, followed by a free lunch and meeting with the Armstrong Advisory Group as we give our perspective on what has happened so far this year, the number of different markets we've already been through, just getting through October, and what we may see as we head into the end of year and 2026. We'd love for you to join us. There's a few spots left. Again, Chestnut Hill Showcase Superlux, Thursday of this week. That's the 16th of October. Kick things off right at 10 a.m. when the show starts, but we'd love for you to join us for all or some of the program. You can call us at 800-393-4001 to reserve your spot. You can get a bunch of details at armstrongadvisory.com. There's a banner right at the top of the page with the details on the event. 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
All right, well, I'm reading maybe the over-exaggeration of the week here with the shutdown, government shutdown consequences for the Bureau of Labor Statistics being dire. But I will admit that we are on the cusp of maybe losing out on a whole bunch of information here. So again, the BLS puts together a number of reports on the state of the economy, including the Consumer Price Index and the Jobs Report, two of the ones that we cite most frequently on this program. First off, that jobs report, we missed the one for September, but the BLS did compile all the data for it. So presumably we will still get that report at some point. The survey period for these reports occurs in the middle of the month, meaning if the government remains shut, there's a good chance that we just won't get a report for October because they do need to survey these businesses and these households, which is currently not happening, and it usually would be. So even if the government manages to reopen tomorrow, which doesn't seem likely, I would suspect that the data gathering process is going to be shortened and it's going to be difficult to get a good read on the labor market. The longer it goes on, the bigger the chances like, oh yeah, you just can't put together an October jobs report because it doesn't make a ton of sense to ask people in December what the state of their hiring was back in October.
Right.
So there is that chance. I think, look, the bigger risk overall is that this type of data gets called into question. It already has. The president fired the old head of the BLS and has put somebody in there who's been questioning the methodology and questioning, where it all comes from. I think most experts would agree that their methodology and the way that they do all this, while imperfect, is probably the best that you could do. And so do we get a large absence of this data, and does it further call into question the credibility of this data in the future is what is on my mind. My answer is largely no. I think if they were going to do that, then you would have seen evidence of it. But, that is a threat over there. And I think these types of data points that you can rely upon, that are released regularly, and that you don't have to question like you do with every data point coming out of China, makes the U.S. economy and markets work in an efficient way that can't exist in other parts of the world. And so this is to a huge benefit.
Yeah, and no question. And the other concern that I have is for the Federal Reserve, who is effectively flying blind for longer and longer periods of times the more that this drags on. That is certainly a challenge for them in what was already a very challenging environment.
Let's take a quick break. When we come back, we'll touch on markets again, which are, again, trying to rally into positive territory. After that, stack roulette.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Mark Vonner is the CEO of Veterans Development Corporation. Mark is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Mark comes from a proud military family, including his father Victor and his brother Timmy. Mark talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Mark is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Mark, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Mark Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Cushing & Dolan want to help you make the most of your estate plan, starting with how you gift your assets. Their brand new guide, Making the Most of Gifting Assets, breaks down the pros and cons so you can avoid costly mistakes. Gifting may sound simple, but it can create complications you may not see coming. For example, if you gift your primary home to your kids and they sell it, they could face huge capital gains taxes, and that surprise bill could derail your plan. It's the kind of insight that can help you protect what you've built and keep your family's future on track. Whether you're just getting started or you're deep into your estate plan, this guide from Cushing & Dolan is a must-have to make smart, informed decisions. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange brought to you by the U.S. Virgin Islands Department of Tourism. Looking for a getaway that's easy, warm, and unforgettable? Discover the magic of the U.S. Virgin Islands, St. Croix, St. Thomas, and St. John. Just a short flight from New England with no passport needed and no money to exchange. Soak up the sun, stroll along white sand beaches, and feel the rhythm of the heartbeat of the islands. The USVI is America's Caribbean paradise. Plan your fall escape now at visitusvi.com. That's visitusvi.com.
We've got markets staging a comeback here. Dow Jones Industrial Average currently up 126 points, about 0.25%. The S&P still down, but now only 9 points, a little more than 0.1%. And the NASDAQ down about 129 points, close to 0.6%. But both the S&P and NASDAQ were off substantially more, as was the Dow. But all three major indices staging a bit of a comeback in early trading. Again, the concern for markets this morning was stoked by further escalation between the United States and China on the trade tariff front, and specifically China targeting some U.S.-owned ship-making assets in South Korea. So what do you have for us for Stack Roulette, Paul?
Mike, we've been talking a lot about perhaps there's an AI bubble out there. We'll see on that. One thing that I think is a bubble that's not getting talked about enough is protein in food. Okay. It's getting out of control, where you've got the likes of Doritos announcing that it has a higher protein version of its product. You now have Pop-Tarts announcing that they have a higher protein version of their product. You've got Eggo waffles. You've got...
Is this everybody trying to make a product for, like, gym rats? Like, what's going on here?
Health conscious.
A lot of this ties in exactly what Tucker's mentioned, is health conscious, the fears around...
How does me eating a Dorito with more protein make me health conscious?
Because they think you're dumb, that's why. That's literally what it is.
That's all.
They put protein on the box. They're like, oh, well,
jury's out.
Is going to buy this.
Jury's out. I might be dumb. Might be dumb enough
TBD.
to buy that. Like,
Many users
My kid didn't eat his chicken last night. I'm going to give him a Pop-Tart.
Yeah, same thing.
It's got protein in it, babe. Don't worry about it. It has 60% of his daily sugar intake, but it has a little bit more protein.
Okay.
Many users of GLP-1s are allegedly looking to increase their protein intake to retain muscle mass, so that's part of this push as well, sort of betting on this idea that those drugs for weight loss become more popular, and as a result, catering their products to those consumers. But
how many years do you give it before the protein additive that they have to put in there, we'd learn, is just as harmful as the artificial colors?
I can't speculate on that, but I can.
5 years? What's the over-under
I can predict that there's no way we're still doing this protein craze a year or two from now. I just don't think. Now, the experts may be against me here, because apparently they claim that there's a long way to go. The global market for foods fortified with protein is estimated to reach more than $100 billion by 2030, up from $67 billion in 2023, according to Grandview Research. I'd like to bet the under on that.
I'm just picturing, again, there's a lot of reasons I don't go to the gym, but I don't go to the gym. But I'm just picturing, one of those giant dudes with the huge arms, tiny little chicken legs, and, muscle milk in one hand and a bag of Doritos. And then you've got the dusty orange stuff getting all over the weights, and just, it doesn't seem...
Not only that, but Mike, fittingly, it's Doritos Jacked. So
Doritos Jacked
that works really well.
Yeah. Muscle milk and the Doritos Jacked seems to fit right
That's a very good image for those gym guys to have. But the same thing applies with Eggo, waffles, and Pop-Tarts. It's everywhere.
There's a coworker that I have who Paul knows immediately who comes to mind, but I'm just going to have to load up on all of this stuff and put it right in his office for him, because not only, is he a workout enthusiast, but he frequently does eat Pop-Tarts. So
now he can get his protein fix there.
I will have to make this clear to him and just stuff his office with it. You're putting too much solar on your roof. I don't think anybody will be over the course of the next several years here, as a lot of those tax credits now phase out. But I do recall when I was putting it on my own roof, a number of companies talking to me about how much that I should put on there, and especially my father-in-law out in Arizona, when he was doing his, they were proposing like, hey, put these extra panels on your roof. You can sell it back to the grid, and put up 130% of what you actually need, and you can make a killing on this stuff. Some people calling that into question now, because what many of those utilities are finding is, during the peak generation times, we don't need to buy all of this solar back from you. We have no use for it. We have no need to take all of this extra capacity. It is not helping us in any meaningful way. And so when I did it on my own, it was primarily because of the tax breaks, but it is probably going to pay back in about 6 years. But I specifically targeted like 60% of what I might use, so that I'm not reliant on selling it back to the utility company to make my money on all of this.
So the utility companies, they don't want it.
in some places during certain times of the day, they don't need it, they don't want it, and they can't store it.
The storing stuff, yeah.
Quick break. Markets making that comeback I mentioned. We'll have a full recap for you tomorrow. Have a great rest of your day, folks.